You're good to go.
All right. Thank you, Ben. Good morning, everybody. Welcome to October. Welcome to full-on harvest season out there across Ohio, much of the Midwest. And Ben and I love the opportunity to visit with you all and to basically look at the climate outlook and the grain market outlook as we sit here at the 1st of October. So beautiful picture taken this week by Aaron Overholser out in West Central Ohio. Thanks for sharing this. Just a beautiful, hopeful picture. You know, we're going to cling to any hopeful news that we possibly can here in this strange year of 2020. So let's go ahead and dive in and get started here. What we're going to do is I'm going to present about 25 minutes on the climate, take a couple questions if you have it, then I'll turn it over to Ben. He'll present as well, and then he'll take a few questions. And then if there's any wrap-up questions at the end, for sure, we will take those. Links will be provided. We'll have a recording for this along with the slides available as well. So buckle in, get ready, and let's take a look at what we're dealing with when it comes to climate and outlook, a grain market outlook this season. All right. So we'll start with the growing season, kind of a review of 2020, mainly for Ohio, but we're going to hit a little bit of the Midwest as well, looking at the conditions that we experienced out there. And I'm going to jump us all the way back to last winter. It's a good place to kind of start, you know, to get our minds, well, what was it like heading into the spring season? We were coming off our 5th warmest and 22nd wettest on record for Ohio, respectively, those going back to 1895, so ranking those 125 years. It was our 5th warmest and 22nd wettest on record here across Ohio. And you can see really warm across much of the Midwest. Soils were, as you'll see in a moment, warmed rapidly during the month of March. And as you know, as far as accumulation of precip, we were okay here in the Eastern Corn Belt region, also up across the northern part of the Midwest. Really, winter was pretty dry in parts of Illinois and Iowa already. And that's going to be, I think, important as obviously we headed into the summertime here in places of Western Ohio. So, you know, if we take a broad view of the growing season, and I've just delineated that here by April 15th through September 15th, and I'm showing you the average maximum high temperature departures from the long-term average on the left and overnight lows on the right, you could see a lot of areas across the Midwest, including Ohio, are shaded gray. You know, if I was asked, how was this growing season overall, I would say it was a pretty average season. Now, if you've been with me long enough and listened to me talk, I always talk about averages and how they blend out those details. And certainly that's the case this year as well. We're going to dive into those details because they're important for agriculture. But this in general was an average growing season temperature-wise across the region. The green shadings are slightly cooler highs, especially in the southern part of the Midwest, southern Ohio, and slightly warmer across northern Ohio, a few pockets. Overnight lows weren't quite as cool, especially compared to average. And that's been the long-term trend as well. We know that our growing season temperatures are warming. They're staying warmer because we've got more atmospheric moisture out there to keep those temperatures really out of the 50s and 60s most of the summer. Looking at the growing season precip, you can see a large range across the region. In fact, a large range across Ohio. If you're sitting up in Northwest Ohio, and I see Bruce on this morning, you know, you're looking at 5 to 10 inches max for that, or yeah, 7.5 to 10 inches or a little bit more across Northwest Ohio for the entire growing season. Southeast Ohio, a little bit better, 20 to 30. So we really got a difference, a range of conditions of precip across the state for the growing season. It's been very dry across parts of northern Indiana, Northwest Ohio, extending into North Central Ohio, and now lately really drying out in Southwest Ohio. And everywhere in Ohio has not escaped some period of dry weather this season. And I'll show you that in just a second when we look at the soil moisture maps. Now, if we look at March, again, or we look at spring, March through May, that's how we define it from a climate perspective. This was the 42nd warmest spring on record between 1895 and 2020. So if we remember, I mean, a lot of us probably remember the cold April and May, and that's true. That was the 34th and 42nd coldest April and May, but we had our 11th warmest March. And again, how do averages work? We take a warm month and a cold month, we blend them together and we have close to average, right? But that's not how we experience things. And so, yeah, March was fairly close to average temperature-wise, but April and May certainly were very cool. And I'll show you some soil temperatures in a second. Excuse me. We dealt with a lot of late season freezes, not to the extent that were really damaging, I think, across the state, especially across the northern stretches. There were some orchards in Sandusky County and some specialty crop hits, obviously, and a lot of damage to early grape varieties and things like that across southern Ohio. But I just want to point out, and I can't believe I didn't fix this. Sorry about that. The morning of April 22nd, we were looking at low temperatures across southern Ohio here in the really the mid 20s, mid to upper 20s. And we can look at our probability of a later freeze in spring indicated, for instance, this is for Hillsborough down here in Highland County. So we can see, April 22nd, we're talking, less than a 10% chance of this occurring. So it was really a 1 in 10 or even 1 in 15 year event this season with these late season freezes, quite chilly across the region. That did have impacts on our soil temperatures, obviously. With the 11th warmest March, you see these time series of the air temperature and the soil temperatures going up during the month of March, and then the big cool down during April. So, dreams of a lot of early planting, I think, some got done obviously, but dreams of widespread early planting were kind of dashed with that cool April. And then we had to recover once again. So really a roller coaster of spring soil temperatures across the state. When we look at precip for the spring, it was our 17th wettest. And again, I want to just keep in mind how wet it was across the state for the springtime. Not everywhere, already across Northwest Ohio, we were looking at hints of some drier weather here, an inch or two below average. But for instance, here in Central Ohio in our spring, we were 8 to 10 inch surplus in terms of our rainfall. So very wet, especially in March. So warm, wet March, cold, kind of middle of the road April, which set us up for the growing season. But as we got to the end of May, we actually already started this really rapid tropical season that we've had this year. So this is Tropical Storm Bertha that actually crossed the eastern counties of Ohio, brought some rainfall in May. And we've had a few tropical influences this season, but kind of an impressive satellite image on the right-hand side and the radar image that's kind of teamed up on the left as well. So we got into our summer and conditions switched, right? We got into June. We started drying out pretty rapidly. This was our 11th warmest summer on record going back to 1895. So quite chilly or quite warm, particularly in July. So as we dried out in June and then July brought on the heat, this was the 6th warmest July on record. And that's really what started and kicked off some drought across the region, first in the Northeast, but then filtering into other areas as well. And again, combined with the heat, we had the lack of rainfall. This is on the left, the total accumulation for the summertime. Very light totals here across Northwest Ohio, a little bit more across Southeast and Eastern Ohio. And you can see the differences here. So we were running deficits throughout the summer on the order of 6 or 7 inches or more across those far northwestern counties. But a lot of areas of Ohio experienced some sort of dry conditions this season. And so that as you'll see in the drought monitor maps here in just a second. We also dealt with some severe weather. This was what I call derecho number 1. So derecho is a long-lived line of thunderstorms, does a lot of damage with this. This was an outer band of another tropical system, Tropical Storm Cristobal, that came across Louisiana, actually tracked across Iowa as well. But that outer band brought that line of thunderstorms through and some tornadoes and a lot of wind damage. Now, looking at our soil moisture kind of map, we're going to step through the months here. These are percentiles. So everywhere you see green, it tends to be on the higher end of what's happened historically. The yellows and oranges are drier. So we could see, we had that fairly dry, fairly moist winter, especially January, February. So we started moistening those soils up. And by the time we got to March, March and April, most of the Mississippi region, Mississippi River Valley, was wetter than on the high end of those percentiles. But as again, we got into to May was really our peak across Ohio. We had our southeastern counties in the 99th percentile, for instance, and then we really started to dry out. So we see June, July, August. This is where we were sitting. Certainly, this is the top meter here. One view of this. We can look at the satellite image and satellite data from June into September here, and just note how basically the orange and the reds show where the dry areas are. That lack of soil moisture sort of moves around the state a little bit, initially across the north, and that's where it starts to intensify. After that warm July, we started baking all these soils, really drying out. And you'll notice in July, kind of focused in the Northeast. And then as we switch to August, this is the end of August now, we've switched back to the Northwest. And of late, we really shifted it south. So we've migrated the dry conditions around the state all summer long. Of course, the big story from the Midwest is the Midwest derecho that really ripped through Iowa. We've all heard about. We had gusts over 60 miles an hour for about two to 3 hours, some 90-mile-an-hour gusts over a period of an hour and a half, and it just leveled and flattened a lot of things from Iowa through northern Illinois. It did enter into Ohio. We had sort of died here in Ohio, so this was our derecho number 2. For the season. This is some severe thunderstorm warnings on the radar here in west central Ohio, but it didn't do near the damage here in Ohio that we had out in Iowa and Illinois. So dryness and drought. So we're going to step through very rapidly the conditions that we saw on the U.S. drought monitor here, because I do want to get to the outlooks today. But as we sorry, I got distracted here at home. As the dryness started to enter across the state here, we had some D1 conditions, again, moderate drought conditions up here in Northwest Ohio, and then along the spine of the Bellefontaine Ridge here around the middle part of July. And this sort of expanded again with those dry conditions, a large portion of the state, good 37% of the state covered by moderate drought conditions at the peak. And then we started to improve a little bit as we got into August and into September. So we started to improve. We had the Labor Day storm that brought 3 to 6 inches of rain across northern Ohio. But since then, the taps have turned off once again, and we're starting, as you'll see in a moment, to see that expansion. We always think about not just the precip during the summer. I don't want to belabor this too much, but I just want to give a point of how locally detailed things get. So, we have precip, we have evaporation. Evaporation is moving that moisture from the surface back into the atmosphere. And we look at the total water balance. So it's more than just precip during the summertime, but how much are we using on a crop, and also how much is evaporating. I just want to give this example. This is Darke County in the top right, Eaton County here, Eaton and Preble County in the bottom right. And we could see how the conditions are very similar in dryness throughout much of the summer here. And they were marching along. And then Darke County picks up this Labor Day storm while Eaton misses out. So, these are very important maps that help us delineate the areas that we're seeing drought and where we're not seeing drought. So very important. So a couple of photos across the region as we went through the season here. Mark Bodicher up in Hardin County, just dryness at the wrong time here for corn, really rolled up tight. That pineapple corn, as we say. Amanda Doritas shared this from Champaign County, some clear drought impacts. And poor Pickaway County sort of, lost it early on. I know I saw Mike on the call. Just wasn't able to pick up any of the scattered rainfalls that kept others at least, limping along a little bit. And certainly this was a fairly decent field in what otherwise was, a lot of things that just were done pretty early from the dryness. I mentioned the hurricanes. We had Tropical Storm Bertha, Tropical Storm Cristobal, and also Hurricane Laura in August, which hit Cameron, Louisiana, and then a little bit came up into southern Ohio. And I've got a question here, more to come. It's possible. We still have about 35% of the hurricane season left to go. So we've got some time to monitor what's happening. All right, so let's get to the conditions now and the outlooks moving forward. Over the last, 7, 30, and 60 days, this is how temperatures have compared to average. Certainly, we've been kind of on this roller coaster the last couple of weeks. We've got some chill in the air today and this week, but last week it was on the warm side. We were generally 2 to 6 degrees above average, at least between the 23rd and the 29th across the state, and really warmer than average over much of the Midwest. Over the last 30 days, because of that roller coaster, we've got some areas below average or above average, but fairly close to average, really, if we look at the last 30 days and 60 days coming off that warm summer, autumn compared to average so far. And I say autumn because we've had a whole month, climatologically speaking, since we started September 1. It's a little bit cooler than average in some areas of Ohio. So a little bit transition here in this season. We have been fairly dry over the last 7 days. Really, this precipitation on the map just shows one day. We had a little bit more last night that's not indicated here, especially across our southern counties. But this was actually a storm that kind of overachieved a little bit. I was only expecting about a quarter to half an inch, and we actually picked up a band of 1 to 2 inches here across the I-71 kind of corridor here, and a little bit also heavier amounts in southeast Ohio. So that's good because we really went 2 weeks without rainfall for most of us, and not everyone picked up heavy rain. As you can see up across northwest Ohio, still really dry, not picking up a lot of rainfall. And this is our drier kind of part of the year as well. So if we look at our precipitation differences compared to average over the last 7, 30, and 60 days, you can see a lot of dryness. Now, especially in the last 30 days, dryness has been extending from southern Indiana into southern Ohio. We're not necessarily, at this point concerned with dryness yet. I mean, obviously it does start to cause some issues, but generally we want a dry harvest to get stuff in. Although we've heard a lot of field fires and combine fires reports out of northwest Ohio and other parts of the Midwest. So that certainly is kind of an elevated risk with these dry conditions. Current snapshot of our soil moisture, again, that dry tongue really extending across southern Illinois, Indiana, and now into southwest Ohio. And our satellite products really showing those dry soils out there in the top 2 meters of the surface. One thing we've not experienced really too much is low stream flows over the last 7, 14, 28 days, or even all summer. We had, isolated low stream flows, but generally nothing widespread. You could see all of these, a lot of green dots, which is close to normal stream flows for this time of the year, which tend to be low this time of year as well. So the latest Ohio River Forecast Center is calling for the next, month out. So for the month of October, stream flows probably going slightly below average with this kind of persistent dry conditions that we've seen. Although the storm this week and a few scattered showers that we'll see this week could help stave that off just a little bit. I'm going to skip this one. We're getting into that time of the year where moisture demand is shrinking, and I'll show you that in a second. This is the current U.S. drought monitor. Really bad conditions out west that have helped drive and contribute to the wildfire season that we're seeing out there. And it's not getting any help from this weather pattern this week either. Here, we've sort of pulled back drought conditions just a little bit. You can see that in the upper right. And as a matter of fact, the latest outlook came out, 19 minutes ago, the latest U.S. drought monitor here. And we've extended dry conditions across, several counties here in southern Ohio as those dry conditions persist. So what are we looking at? And I'm really going to go from the short term all the way out through our winter here, looking at the weather for the week ahead. And we'll start this week. We've had a series of cold fronts move through the region. We've got another one poised to slip through today. A small weak disturbance. It could fire a few showers out there. Again, not looking at anything too heavy, but a brief heavy downpour is certainly possible. As we get into tomorrow, we'll get behind that cold front. And again, we'll actually have another little secondary disturbance or front move through. Could pop a few showers across northern Ohio, but again, nothing too heavy or widespread. We'll start to get into some, Saturday really under high pressure here across the Ohio Valley. The blue on the map up here across the northern Midwest, yep, that's snowfall. Not unheard of, certainly for that part of the country, but it just goes to show how rapidly things start transitioning now to our winter season. Sunday we'll have another disturbance come through, probably a good chance of showers on Sunday, and then behind that for Monday, Tuesday, Wednesday next week, high pressure and control. So over the next there's a lot of opportunities for harvest. I think over the next week, even if we can dodge a few of those showers. As well. Looking beyond, so for the next seven days, really in Ohio, we're only looking at a 1/10 to about a ½ inch of rainfall. Could be pockets of slightly heavier, but widespread. I'm not looking at any heavy rain event. And again, this is looking at evaporation here on the right. That's down around a ½ inch to 3/4 of an inch now per week. Whereas, in the middle of July, we were losing, 1 3/4 to an inch, 1.8 inches of moisture from the surface a week. So, as that sun angle gets lower, evaporation is not really a concern. So now we start looking at a little bit longer term, 8 to 14 day outlooks from the Climate Prediction Center. Across Ohio, we should be, highs in the mid 60s, low 70s across southern Ohio, with normal lows in the mid 40s to low 50s. After this cool period here over the next few days, as we get into that middle part of October, the 8th through the 14th or second week, we are indicating a higher probability of warmer than average temperatures across much of the country, all the country, in fact. And also a big chunk of the Midwest, and there's elevated probability of below average precip. So I think, harvest and combines are going to be running full power here, full steam ahead across much of the region as the weather certainly looks to cooperate pretty nicely for harvest. As a matter of fact, the updated October outlook now, across the Ohio Valley, we're talking about equal chances of above, below, or near normal. This is really kind of a give and take between a cooler start to October, having a warmer middle October. So we're going to see, close to those will average out. But much of the western U.S. under a dome of high pressure is going to be above average, much of the Midwest. And really, we're looking at dry conditions. And these are pretty high probabilities here of drier conditions across much of the Midwest and the Ohio Valley here. So, above 50% probability is really strong on a map like this. Looking at the October through December outlook, again, above average. And a lot of this highly driven by a combination of things. One, just the long-term average. Our Octobers, Novembers, Decembers on the long term are warmer than average, have been warmer than average, largely out of our overnight lows, which is, I want to hedge a little bit this year. With these drier soils, we're seeing these cool nighttime temperatures because at night there's no moisture sitting around, or very little. And that energy is able to radiate back to space really efficiently, and we cool down at night. So, this is the feedback that we're in now, given our dry soils out there. On the right-hand side, you'll see the probability of precip for the fall. And this is setting up the La Nina pattern. And I'm going to talk about that the last couple minutes here. This is just, La Nina tends to affect North America strongest in the wintertime, December through February. But already, the Climate Prediction Center is kind of depicting a typical La Nina pattern with wetter than average conditions across the northern tier, across the Northwest here right now, but really the dryness persisting across our southern tier of states. And that's really what we're going to see. So let's dive into this and kind of end this portion of the presentation talking a little bit about La Nina. So La Nina is not a system. It's tropical sea surface temperatures in the tropical Pacific. So that's what we're looking at here. South America, Central America, Australia. This is along the equator, and we're looking at the current sea surface temperatures here on the top figure on the left. Here, the bottom, we're looking at departures from average. So you can see a lot of blue shadings, cooler than average temperatures in the tropical Pacific. Now, that impacts our jet streams. It impacts the weather patterns that establish across the North America. What we're looking at is this type of typical winter La Nina pattern, where you see a blocking high pressure set up across the North Pacific. This is not good news for places like California and parts of the West that are dealing with the wildfires. This can really block, their typical winter wetness, especially in Southern California, where things tend to be drier. Importantly for us, that variable jet stream here really drives moisture. It dives down across the eastern U.S. and typically Ohio Valley is wetter than average during that period, December through January. So that's kind of what we're looking at as we head into the winter, especially as we get into January and February and even March. So if we're thinking about our springtime, I don't doubt that our soils will recharge this winter, but right now I would hedge toward, we're going to start the season with wet soils. And as we know, sometimes those wet soils take a little bit longer to warm up. Interest in South America when it comes to La Nina conditions here. So the wetter Ohio Valley. But down here in South America, there are impacts during December, January, and February as well. So in this region, across northern Brazil, we're looking at wetter conditions during La Nina as well. And so kind of the northern fringe of the soybean region, the Mato Piba, Maranhão, and Tocantins states here in northern Brazil, certainly looking at wetter than average conditions as we head through December, January, and February for those that have interest in that part of the world as well. Certainly La Nina changes weather patterns across both hemispheres and across different parts of the world as well. So closer to home, a combination of past events, so 22 cases since 1950, combined with our overall trends. We typically get temperatures that are warmer, and they are increasing over that time as well. Precipitation tends to be greater across, again, the Ohio Valley, and is also increasing. And I put a snow here, perhaps, a lot of us do like snowfall. If we can combine some Arctic air with increased precipitation opportunities, that could give us some snow in the winter. Again, I do expect soil moisture to recover well throughout the winter, and then we'll be starting with generally wet soils here in Ohio and the Eastern Corn Belt region as we start our planting season next season. So you heard it first, a ridiculously early winter and spring outlook here with the climate and grain outlook with Ben and I. So thank you so much. If you want to reach out, there are numerous ways to reach me there on the screen. And I think I will start to turn this over to Ben, and we have time for maybe a question. Thank you so much. So let's see. Yep. While Ben's setting up, anybody want to throw a question in the chat? And there'll be some time at the end as well. So seeing and hearing none, let's go ahead and transition over to Ben, who's, I'm sure, got a lot of useful information for us as we head into our harvest season here. Thank you, Ben.
No, thanks, Aaron. I love listening to you talk about weather. It's really exciting, and we're going to talk about some of the same concepts today. So I'm glad you were able to be on and kind of set the stage here as well, and hopefully I can add to your discussion as well. So I'm also really proud of my picture, my title slide picture today. This was sent to me by Justin Willert over in Western Ohio, and just really liked the picture. I liked Aaron's too, and so I think I don't know if these are properly branded by OSU, but I just thought I'd share today as we go through. So this is Aaron and I's second quarterly grain market and climate outlook. And, we travel the state together a lot. And the last couple of years when Aaron and I have gone out in the state, we haven't had a lot of good news to share. Grain markets weren't doing great. There wasn't a lot of optimism in grain markets. And then we had our troubles with planting due to consistent and persistent rainfall. And anyways, now that we've switched to these virtual programs, I've actually had a lot better news to share. And so if we think back to June, when we get in the middle of the summer in the grain market complex, all the attention is put on, expected production based on acreage. And when we were in June, last quarter, we were looking and expecting large corn acres, and we didn't get that. And the expectation was that those corn acres were going to turn into soybean acres, and we didn't get that either. They were turned into corn prevent plant payments, or acres. And so in a way, that helped boost our commodity complex all the way back in June. It swamped, we had basically almost a limit up in soybeans that day because, again, everybody was expecting that those corn acres we weren't seeing were going to turn into soybeans. Now our attention at this point of the year turns into demand. We have a pretty good idea what production is going to look like for the year. It turns into demand. And I have some really good news to share today as well. And so we're going to kind of dive through that. So I don't know, Aaron, what the deal was when we switched from in-person to webinar, but my news is certainly getting a little bit better. So if I can, just a couple of reminders, you can download these slides and access the recording at go.osu.edu/farm office or farmoffice.osu.edu. We also have a YouTube channel. Certainly, if you have any questions, feel free to email me after this, or if you're watching the recording, you can email me at brown.6888@osu.edu. We always love to hear from people. And as you can see, Aaron and I always try to include as many pictures from people that we get as possible. So I want to start out today and talk just a little bit about about what's really driving some of our commodity markets. Because to be truthful, up until just real recent, and by recent, I mean mostly yesterday, we did not have a lot of fundamentals driving our commodity price increases. And certainly, in the last 2 months, we've added $1.60 to our soybean prices. We've seen a 40, 50 cent rally in some places more in the corn market. And we just didn't have a lot of fundamentals to justify that. But what we were seeing was a little bit of an inflation story. And let me explain what that means. What I'm showing you here in this chart right here is representing the M1 and the M1 money stock of dollars that are available for consumers to spend across the country. So this is everything in bank vaults, U.S. Treasury, Federal Reserve, currency, whatever is out there. And we've had a really strong increase in the amount of M1 money supply. If you go all the way back, this is showing all the way from 1975. So you can see the amount of M1 money or the currency that's floating around in the economy. But I want to point a special attention out here to this end. Since March of 2016, when we started the pandemic here in the United States and we started ratcheting up government support and the Federal Reserve started their monetary policy of rolling off banknotes, we've had a 35% increase in the amount of M1 money floating around in the economy. Now, the idea is that this money is going to be going to people that need some support, maybe have lost their job or need some money to tie them over. But the idea is also to help shore up the economy, basically give people money, put money in their hands. They're going to go spend that at the store, and that keeps businesses opening and jobs flowing, or at least remaining available, to where when the economy does pick back up on its own, it doesn't have as big of a jump to make. Now, one of the downsides of all of this is what some of the unintended consequences are. And that's what I kind of want to talk about a little bit today. So that's the M1 money supply. What I'm showing you here on the right is the US dollar index. So this is the value of the US dollar. And this is going all the way back to 1971. You can see the high dollar increases there in the mid 80s. We had a high dollar back in the early 2000s. And then most people think we're in a high dollar environment at the moment, but we're really, we're pretty average, right? We're kind of in this flux in the middle. But for about every 5 to 10 years, or 5 to 7 years, we put in a new high and a new low in the dollar index. So that's what I'm representing here in the purple. And you can see that we put a high in the dollar back in 2016 and we started to fall back down. But then, you can start to see that curve starts to pick back up once the pandemic really started, it starts to drop once the pandemic starts kicking in back in March. And again, this is related to, we had more money and more dollars available across the world. People were trading in dollars. And as a result, that makes the dollar weaker. And so everything that we used to buy for $1 now might cost us $1 plus 10 cents, for instance. And so what happens is we have more money, we have a weaker dollar, it's costing us more to buy products. And as a result, we start to see inflation. And the Federal Reserve Bank has always had a target. Congress tasked the Federal Reserve to monitor the rate of inflation. The current policy up until just real recent was to keep it right at 2%. However, the Federal Reserve just in August did away with that inflation target to where now they allow the inflation index to rise above 2% if it's below 2% for a period of time. And as a result of that move, we're starting to see money flow into commodities that have a story to tell. So again, I'll just finish up here with the dollar, that we've seen a drop of about 9% in the dollar since March. That's a really quick drop over that period of time. And so what ultimately has happened is we've started to see money flow into the commodity sector without a real fundamental shift in supply and demand, right? So what I'm showing you here is I follow about 3 or 4 core commodity indexes, and basically these are certain commodities. This one in particular is the Thomson Reuters Core Commodity Index. It's made up of the 4 components that you see over here on the right. It's heavily weighted to the ags, which is why I like it, is because it's a great indicator of what's happening in the ag sector and energy. But this index is rebalanced every month to make sure that these proportions remain the same. So for instance, if soybeans really explode or the ag complex really explodes, they rebalance it. But what you can see, and let me pull this up here, is really since 2015, we'd been hanging out in a channel. We had, right there in that channel, hadn't really deviated much from top to bottom of that channel until we got to early January when coronavirus was really starting to pop up in places around the globe and then here in the United States. And you see as ethanol was struggling to remain, in operation, as we are having trouble with our livestock packing facilities, you see that core commodity index really fall off. And again, this is partially due to energy and partially due to ag, but we've seen a really strong rebound in this since then. And that's what we're showing to the bottom of that tier. So I think we still got more money that could come into the sector, but it really amounts to commodities that have a story to tell. And what I mean by that is, we don't have to have great fundamentals. We just have to have improving fundamentals to attract speculators. And that's what we have really in the housing market right now. If anybody's been trying to buy a house, or, in the soybean market, for instance, there's a lot of optimism, decreasing yields, lower acreage than what we thought, China coming back into the market, making big announcements and big purchases. And so what I'm showing you here is these are all the open positions of either futures contracts or open options contracts of Chicago soybeans, and all the way back to 2006. And you can see some spikes here and there. These are all these spikes that you see in here are related to drought periods or periods where we had trouble getting the crop in. But the big one here is at the end, right? You see that big spike up. We've had a huge amount of open interest. I want you to keep this graph in mind because we're going to come back to this towards the end of the presentation. But like I said, it's not like we have great fundamentals in the soybean market. It's just that we have improving fundamentals. And again, Aaron mentioned the El Nino in South America. We tend to see El Nino have a decent impact on South American production. Not always, but sometimes, we look at Argentina, especially over Brazil in those cases. And, the ability to maybe pick up some market share from Argentina is possible. But the other component of this is there's really no strong alternatives. People are flowing money into the commodity sector, and especially soybeans, because there's really not anything else out there in the economy right now that's got an overly strong story and it's attractive to speculators. Plus, now we have a tighter supply due to the stocks report this week. And so there's less room for error. And that's also getting people, basically we're not dealing with the hugest stockpile of grain as what we used to. And so there's the hope that we can, maybe have a little bit bullish of a rally. So let's talk about the grain stocks report yesterday. And I want to start off and talk about a special note that came in this stocks report. USDA went back and revised last year's corn and soybean production. Now, it's not uncommon for them to revise soybean production in this report. It is uncommon, and this was a first for them to go back and revise corn production. Now, the interesting thing about this, and I've thrown this up here, they revised corn production up 2.6, almost 3 million bushels, and they revised soybean production down 333,000 bushels. But the reason I bring this up is because not only did they revise 2019 production, but they went in and they revised the June corn stocks number down 205 million bushels. So this chart that I'm showing you down here on the bottom, the black bars there, and if you remember back in June, we actually had so this is actual stocks minus the trade guess, or actual stocks minus the trade guess. So if the bar is black, that's a bearish factor. That means that we had more stocks on hand than what traders expected. If it's a red bar, that's a bullish surprise. We had less stocks than traders were expecting. And you see that back in June, we had a 273 million bushel bearish surprise. Well, USDA just revised the June stocks report, which again, they have the right to do, but they don't do it overly often. Now, this is the second year in a row they've done this here in September, so I'm kind of fearful it might be becoming a pattern. But if you take that 273 and subtract out 205, the trade was actually really close to what the stocks were in June. So that means that we've had less supply all the way since June than what we thought. And that's been an umbrella on our corn market for a period of time. So I threw some tweets just because NASS always answers questions when they're on, when they release a report. And somebody had asked, can you describe what data was available to make these revisions on the 2019 production? And Lance Hoy, which is the crop division leader at NASS, basically explained that you have more data as the season goes on. He basically made the comment that they had learned more since June, and they felt like they could make a revision in the June stocks report based on the information that they have now. But then the second question is related to, well, what was the information that changed the acreage? And according to Lance, again, the FSA and RMA acreage data that came in signaled that there was less acres harvested of corn. And we'll talk about that in the balance sheets here in a little bit. Less acres of soybeans harvested, and that the corn yield was a little bit better than what USDA had originally reported. So that was a big change. That's something that I don't like to see this, because we never know where these are coming from, right? We don't expect them, and they're truly a shock to the market. So keep that in mind as we go through this. When we looked at the grain stocks, our September 1st grain stocks, which represent the end of the year. So this becomes our carry out for the end of the 2019-2020 marketing year. And for corn, we had ending stocks of just under 2 billion bushels. Now, personally, I love to see that as a farmer, because now if I'm a buyer of corn, I'm maybe not as happy, because there's kind of a arbitrary shelf at 2 billion bushels. If we can get below 2 billion bushels, there's kind of like a cloud that's lifted. So we did fall below 2 billion bushels for that 2019-2020 carryout. Now, again, we had that revision to the June stocks report that got figured in here. This is the second year in a row that we've had a very large bullish surprise in September. Last year, if you remember right, we had like a 40-cent rally over a 2-day period in corn after the stocks report, because the 2019 September stocks report showed that we had a lot less corn on hand than what we thought. That same thing happened up again this year. So what happened? And we talked about it. Actually, I talked about it on the road. If you heard me this winter, we talked about when we have a really wet year where we have a poor quality crop, where test weight is low, maybe high moisture, we tend to see these big shocks, these big bullish shocks that eventually show up in the stocks report. Normally they come in June. The last 2 years they've been coming in September. The other question that comes about is how big was third and fourth quarter feed use? So third quarter would have been from March on, fourth quarter from June on. And we're going to talk about that here in just a second, because a lot of people were expecting feed and residual use, and especially feed use, to really drop off this summer due to the challenges we had with the livestock supply chain not moving animals through the chain. Well, this would indicate that we actually fed a lot more than what we initially thought we would. Now, Basis has been telling this all along. If we look at Basis, and I want to thank the folks at Intel SC StoneX up in Bowling Green for doing these for me. But when you look at Basis across the country, we've seen strong Basis in different parts of the country. You look here in Western Ohio, where we got a lot of feeding operations and we're feeding livestock. Down in Southwest Kansas, again, a similar story. But then you also see the impact of that drought and dry weather there in Western Iowa and kind of northwestern Iowa. And so we've seen Basis tell this story all summer, that there's not as much corn out there as what the market was, or what USDA even was telling us was out there. So in a way, it's kind of nice to see the correction happen, because Basis has been telling us this for a while. Now, it got covered up because ethanol plants shut down. We weren't pumping as much ethanol through the plants. We didn't need as much corn. And so that kind of hid some of these inconsistencies that we were seeing between Basis and the stocks report. Now, we're going to continue to see sporadic Basis shifts throughout the spring, or out the winter and into the spring, because that derecho event that Aaron was talking about did reduce the amount of bin space that we have. And so storage costs are going to be higher. We might be piling more grain in Iowa and Illinois. And of course, that opens up the opportunity for more spoilage. And so we could have another bullish surprise in either our June or September stocks reports next year based on that factor. So again, the September report kind of ends the year for us. And so I just wanted to pull this through. And if you want to come back and look at this, I think this is a really cool slide. I like digging through it, because these are the stocks reports for corn at every point for the last 13 years. The blue bars represent corn production here in the United States. So you can kind of see, when we're holding most of our grain. We use, well over half of our corn on hand, almost 70% of the corn that we're going to use for the year in the first 2 quarters of the marketing year. So we're in that first quarter right now. We're going to use a lot of corn this year because we got a lot of animals. The hogs and pigs report that came out last week showed, a lot more pigs than people were expecting back several months ago. And so we're going to use a lot of feed. So I told you we'd talk about implied fourth quarter. So these are my calculations for fourth quarter feed and residual use. And again, what I'm doing here is I'm calculating everything out and then subtracting the ending stocks to be left with the feed and residual use category, which we assume is mostly feed. Technically, it could be some spoilage or lost grain here and there, but you can see last year was one of our strongest fourth quarter feed numbers we'd had. Again, that was that huge surprise that we saw in September. This year, we got another large surprise. Not as strong on feed use this quarter as what we were a year ago, but still extremely strong, and the trend continues to be. But again, we keep increasing grain consuming animal units on the pork side. The beef side, we've slowed down the breeding herd, but we continue to increase the cattle on feed numbers to some extent as well. So when we look at quarterly feed use, and again, these are the quarters lined up just to kind of paint a full picture. What I've done here is, that the red bar represents the first quarter all the way up to the yellow bar being that fourth quarter number I just showed you. And if you add those 4 quarters up, I think our feed and residual use for the year comes in just under 5.8 billion bushels. Now that's notable because USDA currently is estimating a feed and residual use number at 5.6. And, I've had my number somewhere up close to 5.8 for really since March. And so I now there's evidence here that I think we're going to see a revision upwards, and USDA will make that revision here in the October WASDE report that comes out, I believe, the 10th of the month. And so keep that number in mind when we look at total feed use and we put all this together. So this is putting the old crop together. So this is last year's 2019 crop. Again, I told you they revised the yield up a tenth of a bushel to 67.5 bushels to the acre. That increased production, increased supply. Again, I'm adding in 188 million more bushels of feed and residual use to the feed number there above what USDA's got. Now, again, these numbers here in the first column are what USDA had in their September report. They don't have the benefit. They haven't updated their numbers yet. So this isn't fair to them because I've updated mine, but they haven't been able to update theirs yet. But I'm 180 million bushels higher on feed and residual use. I'm 10 million bushels higher on ethanol, and we'll talk about ethanol here more in just a second. And then exports, we've seen a couple more strong shipments of corn just in the last month, so I've increased the corn export number. But all in all, that gets us to about a 362 cash price for the 2019 crop for a season average price. Now that's notable because for those folks that are in the price loss coverage program, that reference price is $3.70. So that's triggering an 8-cent per bushel payment for PLC. Let's talk about demand real quick. So on the ethanol side of the equation, it really depends on how much gasoline we're consuming. And so what I'm showing you here is, the purple and black lines represent the 2019 motor fuel use here in the United States. The purple lines are 5-year average. The red line is actual 2020 gasoline consumption. The blue dotted line was a forecast I was asked to make for the Ohio House. I see Bo on here. This was the forecast we did back when we presented to the Ohio ag committees. And so I've just kind of left that in there as kind of a guide. But you can see we remain well below where we were. And in terms of total motor fuel gasoline, last week we were 6% down. At least based on my blue line estimate there through the remainder of the year, that's a 11% decline in total gasoline consumption for the year. I like to remind folks that gasoline consumption is 3 parts. It's part behavior, part economy, and part pleasure. The fact that we haven't seen some of these schools open up to allow people that are, providing childcare for their families to be able to go back to work. A lot of people like working from home, and we expect, roughly about half of those working from home now will continue to work from home because they either like it or the company they're working for is saving money because they're working at home, and so we'll keep them there. We've also seen less flying. It does equate to more driving. However, the difference here is we haven't picked up as much driving increases as what we've lost on the airline part of the equation. So when we look at ethanol production, we continue to remain about 11% down in ethanol production. We've pretty much flattened out ever since July 17th. This remaining 10% is going to be hard to get back, and I don't see us getting back anywhere close to where we were in the next year. To be honest with you, I think we're going to remain 10% below. That equates to roughly 560 million bushels less corn than what we usually anticipate to consume. Again, ending stocks have been falling of ethanol, which is supportive to price. But again, if you're not using as much ethanol, you don't need as much stocks. And so that number makes a lot of sense to me. But again, it's going to be hard to see ethanol return back to its. I don't know if we'll ever get back to the level of ethanol production that we were at. We've seen a good chunk of ethanol plants remain idled, remain closed. Again, the profitability is there, but as production comes back on, the profitability lowers for everybody. And since there's a couple of companies that own most of the ethanol plants, they're consolidating their industry just as you would expect them to. So when we look at the corn balance sheet, now I'm going to talk about kind of my estimates as we look forward into the outlook. This first graph here, this first chart I'm showing you is exactly what I showed you on the slide earlier. I'm just now putting you a clean copy up. So again, USDA in the first column, my estimates from yesterday that I expect USDA to print here in the next week or two, or the 10th is what I expect them to print in their October report. Now let's talk about new crop. And a couple of things I want to point out. So this first column here is my estimates for new crop. You'll notice that I'm keeping my yield at 178.5 bushels to the acre. My yield model actually suggests that it's higher than that. It actually comes in closer to 179.2. However, I'm leaving it at that 178 because that's what USDA is at, and I don't think there's sufficient evidence right now for USDA to revise that up in the September report. But just so you're aware, my yield model is showing a little bit higher of a yield for Ohio. The other thing I want to point out is I'm leaving ethanol at 5.1 billion bushels. That's about a 10% reduction for next year. As I told you, I think it's going to be hard to get back. Normal would be 5.4 billion bushels. I do have that in my bullish scenario. However, I think that 5.1 to 5.15 is very likely for ethanol production. And then you'll notice I've got a strong export number here. And we didn't talk about corn exports today. Mostly the reason that we didn't talk about corn exports is because our big buyer, China, has pretty much reached their limit. So they have a 65% tax that goes in place once they reach a certain limit. That was the agreement when they joined the WTO. They can lift that if they want, but it's in place to prevent their producers from having to be burdened by an influx of cheap corn. And so they've hit their limit. So I don't expect us to see many exports, at least until the next calendar year, but most of those sales have already been made as well. They can raise that quota, but we'll have to see it before I make some adjustments here. They are showing about a 20 million metric ton shortfall in corn production and what they consume in China right now. So I would expect that they would increase it. I just don't know if they will or when. But this gets us to a 17.1 stocks to use ratio and a 350 cash price for next year. So, that's about kind of where we're at anyways. Now I've thrown up a couple of scenarios here for you. Again, these are USDA's here in the first column, mine are in this, the second column. And then I've got a bearish and a bullish. Really, the biggest change here is the yield, a little bit stronger of a yield and a little bit weaker of a yield. And then the other big one is, does China change their policy to allow for more imports of corn? That's really the two big changes in here. But as you can see, it's a difference of about $1 in that season average cash price for corn. So just something to keep in mind as we move ahead. Should we be rationing our supply of corn? Where we're at right now is this blue dot down here. Again, I don't think we should be rationing corn with higher prices. So I'm not expecting to see corn price go much higher as we head into the fall here. I think we've seen our corn rallies at the moment, and we'll either maintain where we're at or we'll start to fall back down on the corn market. Soybeans is a little bit different a story. And once the mentality shifts to the 2021 crop, we see some opportunities for corn, but at least here in the short term, I think corn's really limited on the upside potential. Switching to soybeans real quick, and I'll go through this real quick and wrap up. But September 1 soybean stocks also surprised the market. They came in at 523 million bushels. The average trade guess was 576 million bushels. So we saw a bullish surprise in soybeans as well, and that justified the market reaction yesterday. If we add this up and put this in the soybean balance sheet, basically, a good chunk of that is going to be captured in the residual function. So USDA, again, the residual is a little bit different on soybeans than corn. So we didn't see really any demand changes in the soybean balance sheet, but just in that residual category. And I've increased this farm cash price 5 cents above what USDA's got for that 2019 crop. Again, the reference price for soybeans is $8.40, so we aren't triggering any price there for the PLC program under soybeans, but most producers weren't in PLC. They were in Ark County for soybeans. Our soybean crush has been really strong this year. Again, what I'm showing you here, this red line here represents the 2019-2020 soybean crush by month. You can see that we broke a record or exceeded last year's amount in 9 out of 12 months, which was just a historic soybean crush year. A couple of reasons for that. There was some logistics issues and transportation issues in South America getting soybean meal out of the country. That offered the opportunity for U.S. producers to take advantage of some of that market. But we also, again, had a lot of animals here in the United States that we had to feed, and soybean crush took over a lot of the lost dried distillers grain from lost ethanol production. So really strong soybean crush. We've seen it fall down. It came in below trade estimates this last month here for August. So September 15th for the August numbers. Part of this, a little bit of what's happening here is we're now seeing some of our competitors start to come back on the market and compete with us with soybean meal. And we've seen soybean meal prices fall as soybean prices have risen. And that removes the crush margin and incentive for our producers. Now let's talk about soybean demand on the export side. We've seen strong exports and announcements by the Chinese to buy U.S. soybeans. Now the trade-off here is we haven't really seen the corresponding exports. They're just sales, which leads us to believe that some of these will probably get canceled. They're an insurance contract in case South America does not produce as big of a soybean crop as what they hope to for whatever reason. It's just an insurance contract. But again, if you look at here's our current marketing year that we're starting. We already had 17 million bushels or metric tons, 17 million metric tons of soybeans committed to China. Which was a heck of a lot more than the 2 million metric tons they had last year, the 1 million metric ton the year before, and you can see prior. Over here on the right, these are those sales broken out into weeks. And so the red bars here, these are new sales before the marketing year even starts. So these are sales for a future marketing year before we even get to that marketing year. And we had a 300% increase when we started the marketing year compared to where we normally are, which are these black bars down here. Then we've continued to have sales here at the start of the marketing year, which are these purple bars. But again, these aren't necessarily transitioning into exports at the moment, which is maybe bringing me a little bit concerned. China really did, they hoarded soybeans all summer long from South America. I'm worried that they're running out of space at their ports for soybeans, and so they're slowing down. What that does is if they're slowing down now and they're not buying sales, they're not taking imports, then they might turn to South America again when we get to March and February. So just keep that in the back of your mind when you're making your marketing decisions as we look ahead. When we look at what this means for implications for corn and soybeans just in general, what I'm plotting here is these are the values. So again, the trade commitments that China agreed to under the FADE-1 trade agreement were both quantity and dollar amounts to get a value, not just quantity. So even though we've seen large sales of quantity, it hasn't necessarily corresponded to the dollar because soybeans were cheap and soybeans were cheap. We've seen a strong rise in corn. Again, we saw lots of extra corn sales that we don't normally see to the Chinese market from the United States. But again, look at these scales here. We're talking about $10, $12 billion over here on soybeans, and we're talking about 120 million, 140 million over here on the corn market. So just kind of keep that scale in mind as we go through here. The other big threat that I think presents itself to us as we look ahead into this winter is Brazilian producers are making out like bandits in the soybean market. So as our soybean price tanked earlier this summer, this was the signal that Brazilian producers were getting. The black line here is the Brazilian soybean price of what their producers were getting in Brazilian reals per bushel. The red line is what our U.S. farmers were getting before this price rise. And so you can see as Brazilian producers were making their decisions about, do we plant more, do we plant corn, what do we do? Soybean market was just exploding. And as a result, there was a study, and I forgot to put the source, I apologize, but there was a study released by the Brazilian Ag University out of Sao Paulo, that these are the reals per hectare this year in return. So this is revenue minus expenses, and you can see just how strong returns Brazilian producers are getting this year. So as a result, we're looking at Brazil. I've got at Brazil estimated increase soybean production 8% this year. That's following 8% last year, 7% the year before. And as you can tell, they're just really ramping up, and they're going to become a major player in the soybean trade. And I think really any concern of can Brazil meet the Chinese demand, I think is probably mute at this point, because they've proven that they can do it year in and year out. When we look at that phase one trade deal, all I'm showing you here is, again, these are dollar values. So again, looking at the quantity times the price. The green bars here are what actually happened this year through July, what we have confirmed reports for. The red line is the seasonal pace we needed to reach the $36.5 million that China promised to buy from the United States. And then based on these green bars here and that red line, these blue bars are what they have to import through the remainder of the calendar year, the remaining months of the year. Now, I think they reached them both in August and September, but you can see when we get into October and December, they're going to really have to step up purchases. And so when you see purchases in the news, it is exciting, and I'm glad to see them, but we need bigger ones if we're going to hit these targets. Now, I'm a glass half full type of person, and so any movement we have towards reaching the agreement, I think, is positive. I think we're going to hit the mid $20 billion, which is a positive and an increase over 2017 when we sent $17.5 billion worth of ag products to China. So I guess just implications for corn and soybeans real quick from the trade one deal. This is being termed managed trade. China's buying more products from us, but it's taking almost everything that we would send to other places. And as a result, this basically effectively becomes an import subsidy of somewhere between 12 and 23% in 2020 and 42 and 59% in 2021. And that's by some researchers at UC Davis. I would be shocked if we hit the phase one targets. But again, I think we're going to be somewhere in that $24 to $26 billion range, which is still above what we did. Last year it was $14 billion. Last year it was $9.5 billion or $9.1 billion in 2018. So still a positive note there. China does need corn. They have to increase their TRQ to do it. I think they can lift it any time. We just need them to lift it. But I think more what's probably going to happen is their state-owned enterprises are going to be the ones importing the corn, which creates problems for us as well, because that's competing against our private-owned businesses like Cargill, ADM, Bunge, stuff like that. The WTO panel just last month ruled against the United States, said that our tariffs against the Chinese were illegal, and that they shouldn't have happened. I think this probably creates a little bit more friction in an already tense relationship between the United States and China, and so those targets could be a little bit harder to meet now that China has actually a reason, basically a ruling to say, hey, you were in the wrong. You owe us for basically treating us, doing us wrong, basically is what that means. And then I guess I just throw this question out there is, what did we really get out of this phase one trade deal as U.S. producers, right? When this started, we were trying to get fairness between state-owned trading companies and private companies in the Chinese market. But really what we've done is we've incentivized state-owned trading companies over private. So we went the other way on that. We were hoping to get less dependent on Chinese market as buyers of our product and find more markets in different places. But now that we've got these block commitments from them to buy our goods, we're sending them everything we have, and we're further concentrating ourselves in that market. And then, we're still waiting on clarification on intellectual property rights in terms of forced technology transfer, turning over genetics, seed traits, stuff like that. Those are going to continue to be issues, and I hope we get a resolvement in some future deal. But I just throw that out there for food for thought. So if we pull this all together in the soybean balance sheet, again, this first thing is exactly what I showed you earlier for the old crop. Let's look at the new crop. Again, USDA's numbers here, and sorry, that says May, but that should be September. I updated the numbers. I just didn't change the title. You look here at this list right here, and then these are my estimates based from yesterday. And really the big difference is I'm not as optimistic about soybean exports as what the USDA is. One big reason for that is Brazil is going to have a lot of soybeans to ship, and their currency is 31% below, or has deflated 31% against the US dollar. Even as the dollar has fallen, the Brazilian currency continues to fall, and that makes their products cheaper. And so when they have products to sell, look for buyers to turn to Brazil automatically because their product's cheaper. The other thing is I've got it crushing a little bit stronger. We saw record crushing this year, and I think we're going to continue to see strong crushing because we've got a lot of livestock, and we're going to continue to see fewer dried distillers grains produced, allowing soybean crush, soybean meal to fit into those rations, into those soybean rations. I've got my bullish and bearish scenarios over here on the side. Again, really the only thing I'm changing is the yield, and then soybean exports based on if China's in the market or not. But you'll notice it really creates a major difference on the soybean market. It is not hard to make. It's not near as hard to make soybeans bullish as it is corn. Corn is difficult. I think there's a ceiling on the corn market. Soybeans, there's room to run on the soybean market if some things play out for us, right? Right now, soybean yields and prices across the country are coming in stronger than expectations. Not everywhere, but in some places. And again, we're going to have to continue to see much stronger shipments and sales to China for me to feel comfortable with these export numbers down here. But just some food for thought in terms of those exports. Again, when you look at where we sit in relation to our historical standpoint, there's kind of a pretty natural break right at 8% between really rationing up and rationing demand. We're sitting right here, almost 10% stocks to use as a percentage of our price, or as a relative to our price. So we're getting close to where we're going to start rationing demand through higher prices. But right now, I feel like we're still in a comfortable spot, even though we've seen this price rally. It's been mostly the influx of cash into the market rather than fundamentals driving that price. And as you can see here, this is just exactly what producers are seeing. All the way back in June, we were down in the lower percentile of the soybean cash price, and these are futures prices. So this is the soybean spot futures price for November, and we've rallied up well into the upper 30th percentile, even the upper 10th percentile. So it's got people excited. I told you we'd come back to a chart early in my presentation, and I hate showing this chart, to be truthfully honest, but what this shows is the number of short contracts by producers and merchants. So these are producers that sold futures contracts early in the year, in June, August, and this orange line right here, this is the current year. And so you can see that we had a lot of open short contracts. And so as the market has rallied, those people are now getting margin calls for their product, even though they managed their risk and they took advantage of some early season marketing. This is a year where it worked against them because we've had this August rally. You can't count on those every year. It happens once every 10 years, but so for a lot of people that are just starting grain marketing this year, I tell them not to get discouraged because, there's a probability of these every so often, but we know that over the long run, as long as you continue to do the same thing every year, you're going to be successful on the back end. Now, what could we have done to help protect some of our risk here? Well, if we sold a futures contract in June or July, we could have bought a call option, basically limit our downside potential, but allowed us to participate in the market rally if it continued to rally. Most people don't buy calls in the summer because they just view them as wasted money. We rarely need them. This would have been a year where buying a call would have worked out really nicely. When we look at that soybean carry, so this is now looking out to the next couple of months. So November here, and then the January contract, March 2021, May 2021. We've got an inverted carry market, meaning that the market is giving us no incentive to store soybeans. That's important because basically, this is the type of year where selling across the scales at harvest and buying a call would be a benefit to people that want to do that. There's no incentive to store either on farm or in commercial. Now, that doesn't mean that the market won't rally, right? The market's saying we need soybeans now, and we're willing to give the incentive to bring them in now. If they don't get the soybeans that they need, we could see a market rally. I would just be very cautious around this March to May time period when the Brazilian soybean crop comes into play. I expect this to look very different when we're talking in the March outlook meeting. So I've put these I just put in here as extra. If anybody wants to learn more about calls and what I talked about in terms of a grain marketing strategy and selling across the scales at harvest and buying a bullish call for, like, let's say March or May, I put some slides in here just to kind of help you to go through that. I've also talked about storage decisions. And so what should you be thinking through right now in terms of if you think you're going to store some product? And I basically, these are my 3 harvest decisions. Do I store grain? Do I hedge my stored grain, or do I leave it open to price risk? How long should I plan on storing? Am I thinking until March? Am I thinking until May? Am I thinking until July? If I only have enough storage for corn and beans, but not both, which crop do I store? And so I've added some points in here about both of those, and it goes through. I even show some historical returns from both hedged here in the red line versus unhedged in the black line when thinking about putting grain in the bin. So my summary, and I know I've gone over time. When we look at this, high moisture and low test weight crops tend to create surprises, and that was the case for the 2019 crop. We saw that bullish surprise yesterday as a result of lower stocks than what we expected. USDA also revised the 2019 crop, but this was really a function of we just had a poor crop. A lot of it got fed because it was high moisture. Maybe it molded in the bin. And then that low test weight also creates higher conversion rates when we talk about ethanol crush and into alcohol, non-fuel alcohol as well. And so I usually expect these to come in June. However, the last 2 years, it's come in September. Fundamentals are improving. They're not great, but they are improving for both corn and soybeans. The stocks report were supportive to both commodities, as seen by the market yesterday. It's just soybeans have a much better demand story to tell for fund managers. Even though corn's improving, there's a lot of attractiveness to the soybean market for people that have money and are looking for places to invest it in the market. Traders are focused in on Chinese demand and the committed sales turning into actual shipments. Again, we've seen really impressive sales numbers, but we need those to turn into actual export shipments. I expect we'll continue to see strong sales in the months to come through January. I don't expect to see many this week. China is starting their national holiday today and running through next week. And so I don't expect hardly any sales over the next week. So don't get concerned if you don't see soybeans sales in the news, but we're going to need really strong sales through the remainder of the year. The El Nino is forming over the Pacific. Again, this tends to put a little bit higher possibility of a short crop in South America, especially Argentina. We didn't talk about Argentina exports, but basically the Argentina government is broke at the moment. They need money. The way they raise money is by export taxes. So if you export a product, you're taxed on that as the exporter. And that's how they raise money. Well, their taxes are so high that no one wants to export a product. And as a result of no one exporting a product, the government's not raising any money. So they lowered those export taxes to encourage people to sell more goods. They're still not seeing much sales because the Argentina peso keeps falling. And producers are sitting there saying, hey, I can leave my soybeans in the bin and they're, at least the price is increasing, versus if I sell them and I stick the money in the bank, I'm going to be losing money because the peso keeps falling in value. And then I think just in terms of farm management strategies, think about your harvest and grain marketing plan in terms of what are you going to do when harvest comes, and maybe you're already in harvest. Are you going to put it in the bin? Do you know how long you're going to keep it in the bin? Are you going to do hedged versus unhedged? I really think you should look at using calls for these soybean markets right here at harvest, just because the market's not giving us any storage. So if you stick it in the bin, basically you're assuming all quality or quantity and quality risk in terms of that physical storage component, and you're assuming basis risk. And then have you considered wheat as followed by second crop soybeans in 2021? If you look at that combination of wheat with second crop soybeans, it's very competitive to full crop soybeans here in the Eastern Corn Belt, and it beats full season corn. And so we've had a lot of back-to-back soybean years where 2018 we had the price drop. In 2019, we had the prevent plant year. We didn't get as many soybeans planted. This year, the corn basis fell right as we were starting harvest, and so we planted more soybeans this year here in the Eastern Corn Belt. So if you've been planting multiple years of soybeans and you need something to break up that rotation, throwing a wheat in there this fall might be a decent strategy. So with that, I want to thank you for your time. Aaron and I both appreciate you joining us and being with us. I'd be happy to take any questions if you put them in the chat box. I'll stop sharing my screen here. And
thanks, Ben. So there is a couple in the Q&A.
All right.
And then we got one just raised a hand.
Okay, so we had one person ask, how could USDA be so wrong on the yield forecast on corn as evidence from yesterday's corn stocks report? So, Mike, I'll answer this in terms of you can either take it as the yield forecast was wrong all year and they were too high on the yield, or we used more demand is how I would phrase it. Now, USDA increased their corn yield, right? That was that 1% increase in corn yield, or 0.1% increase in the national corn yield. And so USDA is probably looking at that and saying, hey, we had some really poor quality corn that went in the bin, and some of that's probably just getting lost. So that feed and residual use category is maybe not as big of feed this year as what it normally is. It's probably a little bit more residual because we lost some. It molded. We fed it anyways, but it was poor quality feed. So I do think the usage component side of the equation, but certainly it would not surprise me if when we get to later in the year, if we're still having trouble with this balance, that we don't see some revisions to corn production. And then the second question today was, so as I see it in my mind, with MFP 1 and 2 and CFAP 1 and 2, the U.S. taxpayer has been helped subsidize commodity sales to China. So we are now, in fact, sending our tax dollars to China. Man, they are smarter than we are. Well, so yes, in some ways, right? I'm certainly not going to say that all the money is going to China, but it is definitely basically what we're doing is we're creating higher prices for the rest of the world. We're subsidizing our producers basically to protect them from price falls here domestically. But as the soybean price here in the United States has fallen, we've seen soybean prices increase around the globe. And that's the result of South America seeing those huge profitability opportunities in their soybean market. And basically what we've done is we've just sped them up on the cycle. They were already increasing production, but we've really sped them up. And same for Ukraine and Russia as well. So that's really the long-term damage right there is people look and say, hey, we gained market share back in the Chinese market. Well, again, it's managed trade. We're sending all of our products to China. I encourage people to look at our share of exports of global trade, and you'll find that they've been declining really since the 1980s and even the late 1970s, but they've picked up. Our market share has picked up the last couple of years. Again, we're just, we're encouraging everybody else to produce more. So. Good questions. Anybody else got any questions? Is there any other questions?
John Roberts. I'm going to open up John Roberts. He raised his hand. So.
Oh, okay. Hi, John. Are you there? Can you hear us?
Okay.
Does anybody got a question for Aaron or I, either one? There we go. We got one. Oh, what's the link for the recording? So it'll be, I'll put it in the chat. Thanks for asking, Lindsay. Give me a little bit and I'll get it put up there. I got to download it, but it'll be at our OSU Market Outlook YouTube page. And then it's also under the farm office under past events, or excuse me, under archived webinars. And I'm putting the link in the chat for everybody. There we go. All right, Aaron, I don't see any more questions. Thanks for being here. Thanks everybody for joining us. We appreciate it. We hope to see you around the state of Ohio soon, and enjoy the weather. All right. Thanks, Aaron. Have a good day.
Absolutely.
Yep.
Yep.